And welcome to our semi-annual State of the Income Address, as I like to call it. In fact, on my radio show, we call it the Retirement Income Source, and our tagline is where it's all about the income. And of course, you're here today with us because you realize that it's all about the income. So today, we're going to go over 2023 with the help of our Chief Investment Officers, Eric and Eric. 2023, what happened to the economy, how it affected the stock market, how it affected the universe of bonds and bond-like instruments, as I like to say, and what we see happening potentially in 2024 and how we might react to it. But before we get into that, just a quick reminder of why it truly is all about the income. And a big kudos to your financial advisor, because you came here, a lot of you came here with different financial advisors that introduced you to us. So a big thanks to that person who was instrumental in hopefully changing your financial life. And hopefully you share the same gratitude toward your introducing financial advisor as we do. Because we're all on a pretty significant mission here at Sound Income Strategies, as is the advisor that introduced you to us. Why? Because in the 80s and 90s, we have what I consider to be a real cancer that was created in the financial services world amongst financial advisors and amongst a lot of do-it-yourself investors. And that cancer I'm referring to is that the stock market had done so well during that period that people got away from basics, and they forgot that the only safe way, secure way to generate retirement income is through interest and dividends. And they started counting on capital gains year after year after year. And when you have a 20-year period like the 80s and 90s where stock market went up double digits most years, it happened to work just through dumb luck, where yes, you can sell a few shares every year and spend the capital, and sell a few shares the following year and spend the capital. In fact, I remember during that time, a lot of prospective clients saying to me, you know, well, the market goes down, it's only for a year, it'll come right back. So I'm going to leave 1 year worth of my retirement expenses sitting in savings. And if the market drops, I'll just spend that money and it'll come right back. That was the mindset back then. So a lot of times when you hear us or you hear your advisor that introduced you to us talking about income, the benefits of income, you may think, gosh, it sounds like the answer to cancer. Well, in a way, it is the answer to financial cancer, because it's really the only secure way to generate retirement income. So in many ways, what your advisor has done is allowed you to get back to basics. And that getting back to basics when it comes to planning for retirement ideally should be done 10 years before you retire. Now, if you get lucky and markets cooperate, you could push that envelope a little bit, but ideally 10 years before. Why so far? Well, simple. You know, we saw from 2000 to 2013, you know, the market was underwater for a good part of 13 years if you were in the S&P 500. So if you plan to retire after 7 or 8 years, and you put this plan together in the year 2000, well, you probably had to work several more years before you could actually afford to retire. So for you who has not retired yet, the reality is that the safe way to generate income, the secure way, is to plan your retirement based upon income growth, right? We know that if you can get 5% income from your portfolio and you reinvest that income, your income each subsequent year is going to go up by approximately 5%. Right? So that way there, you know, pretty much within reason, what your income is going to be so many years down the road, if that's the date at which you wish to retire. Whereas if you're planning on total return and you're within 10 years of retirement, you just don't know. So in the financial markets, as you know, 2022 was a really rough year for everyone in the financial markets because interest rates went up significantly. And as I always quote Warren Buffett, although it's not just him, everyone says this, when interest rates go up, it creates a headwind toward virtually all financial assets. So 2022 was a really tough year. Frankly, I've been in the world of income now for a quarter of a century, and it's the single toughest year that I actually remember because of that interest rate headwind. But like I've said to you at that point, if you're invested here because of the income, because the advisor that introduced you to us got you to see the benefits of income and getting off that total return bandwagon as you get close to retirement and focusing more on income first, growth second, then it didn't matter that your investments were down in value in 2022 in that gosh awful year, right? Because your income stayed consistent. And if you were reinvesting that income, your future income grew at a very competitive rate. Well, 2023 in some ways was the opposite of 2022. Because 2023 was a pretty good year for all of our portfolios. In fact, in the universe of bonds and bond-like instruments, in 2023, we actually recovered pretty much all of our losses from 2022. Now, I say pretty much because, as you know, we have custom portfolios, so a lot of your portfolios look different. And the advisor that led you to us had to decide, okay, which of the bond-like instruments are going to be appropriate for you and your risk tolerance level to tack on to the portfolio of bonds. But if you did all of the bonds and bond-like instruments, you know, the full portfolio, which internally we call Core Plus, I don't talk about that very often, but Eric Lutten might slip and let that out, as I just did. But if you've done that, you essentially recovered all your 2022 losses in 2023. Now, that's assuming you're not taking income. If you're taking income, you might be still down on paper a bit, but assuming that you're not taking income, you've recovered all that loss. But again, just like we say, hey, you shouldn't be upset in 2022 because you understand why income is so important, that it was such a bad year for the actual values of the investments. The fact we had a great year this year really isn't that big of a deal on the upside because, again, income first and growth second. But internally, I have to tell you what amazed me about this was the financial headwind continued in 2023. And in spite of that headwind, we were able to get really competitive returns on portfolios. So what do I mean by that? Well, going back to 2022, interest rates went up 4.25%. The Federal Reserve raised short-term rates by 4.25%, right? Short-term rates are manipulated by the Federal Reserve. Long-term rates are market-driven. So long-term rates actually went up by 2.1%, 2.1% in 2022. So yeah, the short-term headwind, the long-term headwind, headwinds all over the place, right? And that's why even the S&P 500 dropped almost 20% in 2022, and our our portfolios of bonds and bond-like instruments had that really horrific year in terms of total return. This year, the headwind continued, as I said, because the Fed raised rates another 1% throughout the course of this year. Longer-term rates, based upon the 10-year government bond yield, went up 0.14%. Now, that's not a lot, but it's still a headwind. And in spite of that, we were able to make money on the stock side and on the side of bonds and bond-like instruments, and do very, very well. And part of that, I like to say, is because of the proprietary formula that we use on the bond and bond-like instrument side. Most people think of just bonds, they think of stocks. Well, because we have those bond-like instruments to tag on there, they help over the long run lower your volatility. Maybe not from day to day, but over the long run, lower your volatility and to be able to do better than the markets. We saw that happen in 2021, where the bond index, the AG, was up, was basically flat for the year. And I believe on average, we were up about 9%. 2022, we were down about as much as the AG. In 2023, the AG was up just a little bit over 5%. And with all the bond-like instruments, we're up closer to 15% on that side. So again, a really strong year in terms of total performance, in part because of our proprietary formula, and in part also because of the expertise of our chief investment officers. Now, I don't talk about the stock market for a moment. The stock market last year by the S&P 500 was up 26%, and 26% is a great number. But that doesn't tell the whole story, because it was led by what used to be called FANG, is now called the Magnificent Seven, the big technology stocks. And that started really in the second quarter of the year with all the hype about AI, artificial intelligence. And those big tech companies have a bigger effect on the S&P 500 index than lots of the other companies. So in fact, you have 500 stocks. If you take those 7 out of the S&P 500 index, it wasn't up 26%, it was only up 12, okay? And I'm sorry, if you equally weighted it so that it they didn't have an undue influence on the S&P 500. The S&P 500 would have only been up 12%. And if you took them out of the S&P 500, it only would have been up 10%. And I share that with you because on the stock side, we don't invest heavily in those technology stocks, hardly at all. Why? Because they're not an income-first strategy. They're a strategy that can have the biggest gains in the good years, but also take the biggest hit in the bad years. Now, one last thing that I want to say before we pass it off to Eric Beyrich, CIO in charge of our equity portfolios, and that is that we don't toot our own horn very often. We don't like to toot our own horn because, like I say, if the investments go down and your income first, you don't care that much. If they go up, yeah, it's nice to see an increase on paper, but we also don't care that much. We also don't like to toot our own horn because sometimes, the markets overpower us. Like last year, there's almost no place to hide last year from this interest rate headwind. But I do want to tell you that you might be aware we have exchange-traded funds that are designed to mimic the strategies that we utilize on the equity side and on the side of bonds and bond-like instruments. And those exchange-traded funds actually return generally slightly less than your accounts for reasons that are beyond what we're talking about here. But they're really for advisors that are at the big firms, the Merrills, the Morgan Stanleys, that don't have access to our management. Now they have access to put their clients in that management through the exchange-traded fund. So what's the big deal? Well, we hit the three-year mark, and when we hit the 3-year mark, Morningstar ranks the funds. And they ranked one of our strategies 5-star rated, which puts it squarely in the top 10% of performance in its particular category. And the other fund 4-star rated, which puts us up in the top 32% of performance versus risk. And ironically, Eric Lutten's fund of bonds and bond-like instruments, that was the 4-star rated fund. Last year, now get this, last year, out of over 150 funds in its category, bonds and bond-like instruments, was number one, literally ranked number one. So I share that with you because part of the reason for the performance and such a great recovery we had this year is because the expertise of our money managers. So again, I want to take just this brief moment to give ourselves a little pat on the back to let you know really that you're in good hands and to let you know that the advisor that introduced you to us made a good decision in retrospect by picking us as money managers. Now, you'll see a chat box on your computer. So whenever you have questions, feel free to click on chat and to type those questions in, because after Eric and Eric do their respective presentations, I'm then going to jump in and MC the questions. And I may field some of your questions myself. I may ask Eric Beyrich to field some if they're more about equities, or Eric Lutten to field others if they're more about bonds and bond-like instruments. And a quick glance at my notes tells me that I've covered everything I want to cover. So without any more delay, let's introduce our CIO in charge of equities, Mr. Eric Beyrich.
Hi, everybody. It's a pleasure to talk with you. I'm going to verbally advance the slides. So next slide, please. So as Dave talked about, we're going to spend a little time going through what happened last year and what we think is going to happen this year. We call 2024 a pivotal year, not just because the Fed is pivoting from a restrictive monetary policy to potentially lowering rates and easing policy, but also because the economy is at a pivot point where it can go from a slowing economy to one that grows again, or it could possibly pivot into a recession, which I don't think will happen. So in covering that, I'm going to talk about 6 things. Why equities? I have to be the equity evangelist. As you heard Dave, there's a sort of a negative view historically on stocks because of the capital gains piece. So I'm going to talk about why stocks are a good thing. I'm going to talk about what we do that differentiates us, not only the S&P 500, but what other managers do. We'll talk about what happened last year, where we are now in sort of the business cycle and the equity investment cycle, what the macro outlook is from my perspective for 2024, which is pretty much in line with what I think Eric is going to talk about, the fixed income outlook, and talk about some areas that look good. Next slide, please. So why stocks? Why stocks? Because stocks have consistently delivered higher returns than other liquid investments, in particular, higher returns than bonds. If you look out over the last 50 years, not just the 80s and 90s, but stocks have returned typically 10 to 11% per year, which is twice that of bonds. And if you adjust those returns for compounding effects, tax effects, and inflation, the real returns of stocks have been 3 to 4 times that of bonds. Next slide, please. But there's a catch. Stocks have much higher volatility, as Dave alluded to. In fact, if stocks have an expected return based on history of 10 to 11% per year, on average, stocks are down 14% from their start of year price at some point, or have been during the course of the year. So that volatility is more than some people can stomach or want to stomach. Now, even though stocks, 3 out of 4 years finish positive on the year, they are very volatile. Next stock, please. So the good news is that volatility risk has diminished over time and continues to diminish over time. So this chart, which is courtesy of JP Morgan Asset Management, shows the rolling returns. And it basically indicates what would happen if you bought at the top and had to sell at the bottoms over these rolling, 3, 5, 10, and 20-year periods. And if you bought at the bottoms and sold at the top. So you get a range of returns over time. This is important because people don't buy or sell everything at the top or bottom. They typically average in and average out over time. So if the average person works for 40 years, they're saving for 40 years for retirement. The average retirement is 20 years, so they're drawing out. So you're putting in about 2.5% a year. This is linearly, and you're taking out 5%. So looking at that 20-year rolling average, the worst that you would have done on a pre-tax basis in stocks is 6% a year, and the worst in bonds would have been 1%, and the best is 17%. This is the average annual versus 12%. So what that says is that really that stocks are wealth building assets. Now we focus on income and stocks for generating income, but really there's nothing that supplants stocks for building assets over time. Next slide, please. But performance is cyclical. You can't be a winner every year. And while stocks have generally outperformed bonds in 4 out of 5 years, there are certain periods of the economic cycle where bonds consistently outperform stocks, and that is in recessions or periods where there is a recession. And those times, as you can see in the middle set of bars, bonds meaningfully outperform stocks, even though more often than not, stocks beat bonds. So in the second half of 2023, we had this perfect situation for fixed income where interest rates were falling, and that really helped the bond returns. It also helped the equity returns as well. And now as we are in 2024, there's still some concern about recession, but there's still the prospect that interest rates will fall further, which should help stocks and bonds, but typically bonds more than stocks. Next chart, please. Our strategy is very dividend oriented, and dividends do some things for equity investments that are really virtuous. It shortens the duration of the investment, which makes it less interest rate sensitive. Also, dividends tend to grow with economic growth of the companies, and it also grows with nominal growth, such as through inflation. So they offer an inflation hedge that you typically can't get through fixed income or other vehicles. So historically, the S&P 500 has gotten almost 40% of its returns from dividends. Now, dividends in the S&P are very low today, but in our portfolios, which typically have 2 to 4 times the dividend payout rate of the S&P, it's a bigger factor. Perhaps the most compelling evidence of the virtue of dividends on the slide is the right-hand set of columns where it shows that dividend stocks on average outperform non-dividend stocks by 40%, and they have a lower standard deviation. So in the investment world, when you can get something that has a higher expected return with a lower expected level of risk, that's a gift, and that is what dividend-paying stocks historically have done. Next slide, please. So what do we do that makes us different? We truly are different. We focus on high dividend value with the catalyst stocks. So it makes us value investors as opposed to growth investors. And really, uniquely high dividend oriented investors. As I mentioned before, our portfolios typically have, 2 to 3 to 4 times the dividend payout rates of the index, which gives us more certainty of the cash flow, but it should lower our volatility and raise our return over time. Those companies that have higher dividends typically have lower growth expectations. So we choose to combat that by looking for companies with catalysts for fundamental improvement. We look for things that have low expectations where we have a chance for beating those expectations. Now, it doesn't work all of the time, but that historically is why value has outperformed growth more often than not, is because it's easier to beat low expectations than high expectations. When we find cheap stocks, we look for companies that have problems that are fixable. And stocks aren't cheap by accident. They're cheap because people think there's something wrong with them, and oftentimes there is. So our goal is to find things that we think can be fixed typically within a 3-year period. And the good news is that the company managements can't fix it and a company is cheap. Usually somebody else will come in and take it over. However, that strategy doesn't always work. Sometimes the issues that companies are dealing with are beyond their control, or they're really secular in nature and they can't be fixed. And so the illustration is really showing what our process is. There's 12,000 companies we could potentially invest in, but when we screen out the ones that are too expensive or they have quantitative issues that make them unattractive, such as negative margin trends or things in that are, intractable, or they have qualitative issues, known bad managements or competitors that are significantly better than they're taking their share, we exclude them. And then we come up with the ones that make it through that screen, which is, typically, less than 0.1%. We have a series of questions and fundamentals that we go back with the companies, with the competitors, and if we can, suppliers and customers, to figure out if the problems really can be fixed. That process is very labor intensive and time consuming, but it usually works out pretty well for us, as Dave indicated with the performance. Next slide, please. So last year's performance was positive, but not up to our liking. And the reason for that, as Dave talked about, is what was working last year was really growth names for good reason. They had real fundamental growth, and they soared. As Dave pointed out, they pulled the S&P up 26%, and if you took them out of it, it was only up 10 to 12%. So high dividend stocks were actually the worst performing category last year because you could suddenly get bonds that paid higher yields that became more attractive. And people said, why have the risk of the stocks when you can buy bonds and get a similar yield? And that pulled money away. And also the economic growth profile lessened. So you're seeing more negative revisions to earnings estimates last year than we've seen. All of that weighed on stocks, which is a big contrast to the prior year. In 22, dividend paying stocks were the best performer. And in fact, we were positive on a year where the market was down 20%. So it's sort of ironic. Last year, value had its worst relative performance in over 20 years after having one of its best relative performances in the prior year. We talked about it before Dave mentioned it. Our SMAs perform notably better than the Divi ETF because of the higher expenses of the ETF mostly and slightly different strategies in the custom portfolios. I don't have the GIPS numbers yet, but my model portfolios indicate that we were up between almost 6 to almost 10% on the SMAs. The next slide, please. So value versus growth. We choose a value strategy which has had a higher frequency of outperforming, but not always. Value tends to outperform growth when inflation is higher, when interest rates are higher, when the economy is improving. It tends to underperform growth in periods of low interest rates like you've had following the quantitative easing period. And also it tends to underperform late in a business cycle when there's deterioration in the fundamentals, but the narrow growth stocks continue to work. We're now entering a period where interest rates are going to be a little structurally higher than they were during the QE period, which favors value, but it's not certainly a lot. Next slide, please. This is a more contemporary view. It shows that on the bar chart with the green bars all the way on the right, that value has outperformed growth typically when the interest rate environment, the 10-year environment, was about 3.5% or better, and growth has outperformed in sort of that 3.5% or worse environment. So right now, the rates, which are over 4% for the 10-year, favor value. However, inflation is slowing down, which helps growth a little bit, and the economy is slowing, which helps growth a little bit. So we expect in the beginning half of 24 growth stocks to continue to perform relatively well versus value. But then later in the year, when interest rates really do start to come down and the market broadens out more, value stocks to come roaring back. Next slide, please. So where are we? We talked about this as a pivotal year. We've had a situation where leading economic indicators have been down for the last 2 to 3 years. But really, if you look more closely at the chart, which is the bar chart on the, or the line chart on the left, you can see that it's been pretty stable for the last 2 years. Similarly, looking at ISM manufacturing, we've had a downtrend, but it's also been stable for the last couple of years. Whereas the ISM services turned positive a little over a year ago and has also been stable. Services are a bigger factor in the economy, and that's why we've had positive GDP growth. So you can see in the bar of data just above the bottom of the chart where it says FOMC forecasts that the Fed expects the economy to continue to grow, albeit at a slower pace this year, 1.5% approximately versus 2.6 last year. But inflation also expected to slow, getting closer to their 2% target, and unemployment to remain very low. This is sort of we call it a okay economic environment. And that's why you have a situation where half of the economists are still thinking that we could get a recession due to lag effects from the Fed's hiking, and the other half thinking that we're not likely to get a recession. If you look more closely at the leading economic indicator data, the hard data, which are things that are measured, shows more strength than the soft data, which are sentiment indicators. So we think that the hard data ultimately will win, and that's why we come out on the positive side. Next slide, please. So where are we in the cycle? We haven't had a normal business cycle or even a normal equity cycle, partly because of the uniqueness of the disruption of the COVID shutdown policies, which basically, broke the supply chains, if you will, or pieces of the economy, and also the QE. But if we were to use this chart, which overlaps the economic cycle and the equity and market cycle, if you will, we'd be towards the end part. So beginning of the year 24 is still falling on a bit from the surge that we had in the last couple of months of 23, where the data supported the Fed cutting interest rates and some thought up to 7 times, which really kited stocks and bond prices. And now that there's a little bit of reversal of that, where it's like, well, the data says, and the Fed say that maybe they're not going to be so aggressive in cutting rates. So the market expectations for rate cuts have been pushed back. So instead of 7 cuts, maybe it's 3, maybe it's 4, but it'll be later in the year. And that has changed the tempo a little bit. But at the same time, the economic data are still coming in a little better than expected. So we had a lot of bumps last year, with the war, with China slowing down, and the Fed is, indicating it was going to pivot or not pivot. Well, this year, we do think the Fed is absolutely going to pivot. There are lag effects, but generally speaking, growth is a little better than feared. So some areas, like we've seen the companies reporting lately, are going to have some meaningful reductions, and others are going to have positive improvements. And that volatility is going to mean a bumpy, I'll say bumpy first half. But once the Fed starts cutting, I think that's going to smooth things out and improve the situation. Next slide, please. So what looks promising and doubtful this year? The slowing economic growth, which we're seeing is good for growth stocks. We also have real economic income growth, and that is that because inflation has come down and incomes continue to rise, people are becoming better off in purchasing power terms. That's going to be good for financial companies and consumer stocks, particularly as rates fall and homes become more affordable. The backslide on the rates in the dollar in Q1, like you've seen with interest rates coming back up a little bit, is negative for cyclicals, and it's also negative for dividend stocks. But we think, like I said, that the Fed will start cutting rates, and that will reverse before the end of the year. Falling interest rates in the dollar thereafter is going to be good pretty much for everything in terms of exports and capital goods, housing, and M&A. In fact, this is going to be a great year for M&A. We feel much more positive about some of the big banks' M&A's prospects than anything else. Raw material prices have come down, particularly food prices have come down. That's going to help the cost of goods against difficult comparisons last year. So we should see some margins improving, but it's also going to hurt the farm equipment companies and the raw commodity companies because they're going to face less demand as the economics of those businesses decline. Election year spending is always great for media and advertising stocks, and those guys have been tagged pretty hard in the last year. I think they're going to come roaring back, and that's going to be a good place to be. Also, munitions are at all-time lows in period because we've stopped making them in terms of the West, and now that's going to be good for those companies that make bombs, basically. EV demand is fading. People don't really want electric cars, although maybe in California they do. So we're also seeing less demand for windmills and projects being cut. So that's negative for those stocks. Those are mostly growth stocks that actually help the relative value equation. The artificial intelligence bandwagon is real. Artificial intelligence has been going on for 50 years. It's basically a higher form of automation. But now that the tools are more usable, accessible, and affordable to people, you're just going to see that being adopted as companies look for ways to lower costs and improve effectiveness. So we think that is going to be real. Our job is to buy things that get knocked out of bed because there's a problem that we think can be fixed. We call it those fallen angels. We're going to try to find them this quarter as that volatility we talked about shakes the trees and creates better opportunities for us. The challenge with high dividend stocks is a lot of the companies that get beaten up don't pay high dividends. So our universe tends to get less of these than the typical value manager, but we expect to get some more. And finally, I just want to emphasize that we pick stocks. All these factors are helpful, but really we look at the company's likelihood for improvement and its yield as criteria that lead us to invest in things. So there's a lot of good stuff out there that just doesn't meet our criteria. And while we might like to invest in them, they just don't meet the mandate, so we don't. So that is it for me. Thank you for your time and your patience. It's now my pleasure to introduce Eric Lutten, our Chief Investment Officer of Fixed Income.
Thank you, Eric. Welcome, everybody. Please remember, if you have any questions, to add them, and we'll see them in our chat box, which we'll get to in just a minute. But until then, bonds are finally back. I'm going to go through our process, our fixed income process especially. We're going to do a portfolio review and our expectations for 2024. All right, for those of you that are new, and for those of you who have been around with SIS for a while, we're going to go through some slides you guys have all seen many times before, but we have a lot of new advisors this year. So bear with us. We want to go through some fixed income basics, review that. Then we'll go through what we expected last year at this webinar last year. So we'll review our expectations, look at our 2023 returns, and also the factors and our expectations for 2024. And then finally, we'll go through any expected changes we think we're going to have for our portfolios and doing strategy updates going forward. So again, many of you have seen these slides, some of these slides before, so bear with us. This is our fixed income investment process. We do what's called a top-down and a bottoms-up review. For top-down, you've heard Eric, Beyrich, and myself talk many times about different economic numbers. We'll talk about what the Fed's going to do, and especially economic, not only the economic indicators, but also we'll go through the business cycle. Like Eric has said before, we've been in a long, late-stage business cycle, unlike many before. We'll also go to the, well, back to the bottoms up, back to that slide. There we go. So, and then we do a top-down review, or after the top-down review, we do bottoms up. This means we go through the K's and Q's, the annual and the quarterly reports. We hop on earnings calls with management, ask the pertinent questions so we can talk about whether this security is good or not for the portfolio. All this top-down and bottoms-up process leads us to our portfolio construction. As you've heard Dave say many times before, we're about safety of principal. And the reason we're about making safe conservative investments so we can earn income. That's the main goal, with capital appreciation a second goal. So if we can earn 5 or 6% income and then give you 1 or 2% capital appreciation over time, that is the goal. Obviously, the expected outcomes, we were trying to build competitive risk-adjusted return portfolio. Now, normally we'd like to see low correlation with equities, but the last 2 years with high inflation and an opaque view of inflation, that usually leads to bonds and equities having a high correlation, which is what we've seen. Hopefully, with inflation coming down in the future, to see it remain pretty low, we should start to see lower correlations between the two markets, which will be good. So, general review of interest rates. We're going to go look through the yield curve, bond spread compression, which you've heard me talk about many times. So we have an inverse relationship between bonds and, rates and prices. We're also going to see a quick review of credit spreads. You've heard me on phone calls with many of you talking about tightening and widening and what that means and why that's important. And then we'll show some different yield curves. Now, you've seen this before. David made me put this in many years ago, and I thought, sure, do we really need to do that? But yes, Dave was absolutely correct. I've been on calls still before where people sometimes forget rates and fixed income price securities are inverse. When the rates go up, the prices come down. So, but that's not the whole story because of credit spreads. So in this chart, we see the 10-year U.S. government bond yielding about 4.08. This morning, it was about 4.09% is what we're yielding. Well, then you have different credits. You have AAA bonds, AA, single A, and the space we really feel is inefficiently priced is the BBB and BB priced bonds. So if you see here, if the 10-year government bond's at 4.08, the BBB credit spread is usually giving you about 1.23% over and above the Treasury curve. And while a high yield BB credit is giving us up to 2.57% over above that 4.08 yield. In other words, it's giving us a spread, which we'll see on the next screen. This brings us to spread compression. Now, again, many of you have heard me talk about this. If today we can get a 10-year BB bond at a 6.5% yield, and the 10-year Treasury, let's say it's at 4.20, that gives us a credit spread of 2.3% or 230 basis points. Same thing. Well, let's say in the future, that 10-year bond for the Treasury widens out. The price goes down, and now it's yielding 4.5%. But we picked a good credit, and for whatever reason, that credit tightened. So instead of being 6.5%, it's now 6.45, tightened 5 basis points, but this credit spread, which was 230, is now 1.95. So just because Treasury sell-off doesn't always mean you're going to get the exact same sell-off in your bond portfolio over time if you're picking good credits. This brings us to the credit curves. Well, this is just a visualization of what we've been talking about. The blue line is the U.S. Treasury curve from 1 year out past 5-year maturities. And then above that's the corporate curve, which gives us a spread. So as you can see, it's giving us a little bit higher yield, obviously, for taking on that extra credit risk over and above the U.S. government. So this brings us finally to positive, flat, and negative curves. The blue line, which is the normal, what you'd hear us say, a normal positive slope curve. When you invest in, let's say, a 5-year bond, you're going to get maybe 2%, but you go all the way out to 30 years, maybe you get 5, 6, 7%. So it's a positive slope. You get more premium or more yield by taking on more duration risk. Now, when the Fed starts raising interest rates, then you might see that curve turn to flat, which is the green line, where short-term rates and long-term rates are equal. And that leads to usually, not always, but usually what we have, and we've been in this environment for the past couple of years, the red line, an inverted curve. An inverted curve usually denotes a slowdown in your economic cycle and potential recession. It's been a pretty good indicator, but this is the first time we've been this negative for this much, for this long, without having a quote recession. So those are the basics of rates, compressions, and curves. That's a quick review of that. So we go on to discussion points. So last year when we spoke, we gave you our 2023 expectations. We stated that inflation would continue to slow. CPI year over year was 6.5%, but now we've come down to 3.4, the 3.4 area. We also stated that the supply chain would continue to improve, which it has tremendously. I believe when I was tracking the Long Beach and Port of LA, they were over 100 ships waiting to dock. Now they're down to just one ship, so there's not much of a wait, thank goodness. We also stated that COVID and the Chinese lockdowns for COVID would subside, and they have for the most part, and the Russian-Ukraine war would eventually de-escalate. Now with another war in the Middle East that the United States is funding, Zelensky and Putin may go to the table because wars cost money, and if you don't have money to fight it, then maybe diplomatic solutions will come to pass. We'll see. We believe that the Fed would ease rate increases. So the Fed did stop in July of this year. And finally, we also said that the Fed would talk about actually lower rates or talk about lowering rates in Q3 or Q4. And in December 13th meeting, Jay Powell talked about being at peak rates. So hopefully that is it for the rate cycle. And then after the meeting, they had their dot plot and released that, which we all know means lowering rates this year in 2024, finally. And then our expectations, our third expectation from last year, we believe that labor would start to slow post-pandemic peak. So the payroll employment was about 2.7 million this year, but last year we had 4.8 million. So it's slowed down tremendously, not quite as much as the Fed would like, hence why our rates haven't been cut yet. Labor is still a big issue for them, but they have come down. Now, one thing we didn't get correct, believed that the GDP would weaken further in 23. We were correct up until third quarter. We had very strong construction and government spending in third quarter. Even state and local governments were spending a lot. So real third quarter GDP, I believe at the second revisement was still positive 4.9%. So we had a little bit of spike in GDP. Due to that belief of GDP slowing enough, we expected that the yield curve would flatten by the summer, and it did flatten by the fall, but then it inverted again further once the Fed started having the dovish talk in December at their December 13th meeting. So, and the final expectation we had was that the US dollar would fall during the year. However, September and October did have a spike, but we still lost 3.1% on the dollar for the year, and we believe that will continue. S&P also had earnings expectations fall during the first half of 23, but again, there was an earnings spike in third quarter, and we'll see in 2 or 3 weeks how fourth quarter earnings for the S&P ends up. So this brings us to how we did. As you heard Dave mention earlier, our Core Plus, we have core portfolios, which are bonds and preferreds. Then we have the Core Plus, which advisors and their clients can talk about, hey, I want to add some bolt-on, get a little more yield over the bonds and preferreds. That's where they can add BDCs, REITs, specialty bond ETFs, which are made up of sovereign debt and private placement debt. Well, that Core Plus portfolio, where most of our assets are, was up a little over 15% for the year. And as you can see on the chart that you're viewing right now on the right, the yellow bars are what we did, and the blue bar is the index. As you can see in each category, we outperformed. We outperformed in the BDC space, the REIT space, the sovereign and private placement debt space, the preferred space, and also our corporate bonds outperformed the index. So this brings us, that's great. We had a great 23 to make up for that nasty 22, one of the worst fixed income markets ever. But here are our expectations for 2024. Now, the CARES Act of March of going back all the way to 2020, all the way through the Inflation Act, which was August of 22, and I'm not even mentioning the Bank Term Funding Program, which will come due this March, which I believe the Fed is going to extend. All that taken into consideration, the Fed has added over $6 trillion in new stimulus money, and that's been driving inflation and, frankly, the U.S. economy along for the last several years. Now that the fiscal spending has faded and we're going to see the Fed tighten their policy even further, we're expecting kind of equity markets, especially, kind of being a sideways trading pattern. And we expect, even though some of the big institutions are saying 2 to 3, or in between 2.5% and 3% in GDP, I think we'll be at 2% or below for the year. Companies with high cash flows and a little amount of debt, not going overboard on the debt, should outperform in a slowdown scenario on a relative value basis. So again, this should be our year, not only for a continuation of fixed income, but also equities, picking value equities with healthy balance sheets. However, the REIT and BDC space could become more challenging this year if rates fall fast. If the Fed does a quick pivot and starts lowering rates too much too fast, we'll see our BDC and REIT space have a little bit of challenge. But again, we'll go through that. One expectation, one risk, I should say, fixed income reinvestment risk will definitely increase this year due to a monetary policy shift and also an possible economic slowdown. What I mean by reinvestment rate risk is we oftentimes will have preferreds and bonds mature. They'll get called away back by the company, or when they mature, obviously we get our principal back. Well, we have to reinvest that principal. And sometimes if rates are coming down, that means we have to reinvest that capital into lower interest rates. So that's where the reinvestment risk comes into play. We also see the yield curve movement from materially inverted, and we'll see it flatter by this summer. And then I think hopefully by the fourth quarter, we'll start to see it move in a positive slope again. These are similar. This is a similar view to what I had in 2023. It has not come to fruition just yet, but we'll see. The carry trade or high coupon securities should continue to outpace credit downgrades that we'll see in bonds and any defaults in 2024. These, again, similar to 2023 views, but there's no need to rush into all high grade or investment grade credit just yet. Now, most of our portfolio are in investment grade, but occasionally if we find a credit that's cheap, underpriced and giving us a good yield with not too much duration risk, we will pick it up. So again, part of our strategy this year, we will definitely extend duration in our bond portfolios. Not too much, given that we already have a high allocation to preferred securities, which already have a lot of duration risk, but we will definitely increase it. We'll continue to review our BDC and REIT portfolios. Like I said, we'll swap into more individual bonds. I want to do this. We did this part of this year, but we'll continue into 24. We're going to swap into more individual bonds and out of our heavier weights. For clients that still had a 15% weight to sovereign debt and specialty ETFs, private placement bonds, we'll look to swap into individual domestic debt going forward where it's appropriate. We'll continue to look through strong balance sheets, strong firms that offer a yield over and above duration. Now, one thing that's been a challenge for us on the fixed income side the last several years, up until the Fed started raising rates, was that we were in a zero interest rate environment, and that becomes very difficult sometimes to get a yield high enough that's above your duration risk. But finally, with these higher rates, gives us an opportunity to invest and make a little more money as savers and investors. So with that, we're going to bring Dave back on to here. We'll listen to your questions and see if we can answer all these this afternoon.
All right, everybody. Well, thank you. It's great to have the expertise that we have here. So many times, I was used to many years ago kind of being the one that ran all the portfolios and talked to people and had to do all the research all by myself. And now I'm at a point where I'm really grateful that I've got technical questions and I've got Eric and Eric to back us all up here. So let's get your questions and let's go through here. If we start at the very beginning, Rich, in the control room, if you wouldn't mind just scrolling up a little bit, I'd like to get to the top there. That's good. Okay, great. Thank you. Okay. For clients interested in income over growth, would it be advantageous to focus more on preferred shares that have a higher yield than dividend stocks? Simple answer, possibly yes, as long as you understand that focusing more on preferreds has more risk than bonds. And even though preferreds on a standalone basis are considered to be more conservative than common stocks, adding a little bit of common stock to a portfolio of bonds and preferreds does lower your overall volatility, because sometimes one zigs while the other zags. Just like in our portfolio of bonds and bond-like instruments, by adding all the bond-like instruments, we can reduce the volatility over the long run. But if income is your primary goal, regardless of that volatility, that you want consistent income for the retirement that you have, then I encourage you to talk to your advisor that introduced you to us, because we can, again, because things are custom, we can make changes in your allocation to help you get more income. And part of that solution might just be going more heavily toward preferred. So Great question there. Next, for questions interested in growth. Okay, so this is people interested in growth. This is like the opposite question here. Will cryptocurrency become an asset class in the future that could be added to the portfolio? If so, why and why not? I think I would, I don't know, Eric, should I give this to Mr. Beyrich? I'm afraid.
I think we know his answer
He
to
might
this.
go off on a bit of a tangent, so I'm not sure. All right, Eric Beyrich.
He
be
might
as
have some
concise-
secretly.
Be as concise as you can here, please, as to why you're shaking your head no.
Yeah, crypto is not really an income vehicle whatsoever. It actually has a negative carry, if you will, because you have to pay to store it. It's a speculative asset class. There's no intrinsic value. And it only works because people have the perception that it will become more scarce. So it doesn't make sense at all for our clients. If people want to speculate and buy something as a sort of a mad money move, then they can do that. I tend to agree with Warren Buffett and the late Charlie Munger that it makes no sense. But people want to play that game, then they can play that game, but we certainly won't.
Yeah. Yeah, it's for, everything we do is income to some degree. And so right then and there, it knocks it out of the box. But even if you were in growth stocks of companies that didn't pay a dividend, but the companies actually made money, it was an profitable enterprise, as fiduciaries, it would be something that, we could in theory at least consider. But crypto in and of itself doesn't do that. So that's a situation where if you really are interested in doing that with some small part of your money, it's a conversation you might want to have with your financial advisor that introduced you to us. I'll confess, I actually own a little bit of crypto too, really just because of FOMO, right? Like the kids have, fear of missing out. So I said, what does it hurt? Do a little bit, and if it's worth zero, well, it's like going to the casino, which a lot of people do, and if it's worth something down the road, well, that's great. But not that I'm a believer in it by any stretch of the imagination. Let's see here. Next, you scroll up just a little bit there. Good. Okay. Can my holdings be more diversified was a question. And I guess I don't know what you're asking or how to answer that, but I will talk about diversification in this way. In our stock portfolios, depending upon, and there's a range from more conservative with a higher yield to a little bit more aggressive with a lower yield. But again, that range, even the lower yielding in our stock portfolio still is a decent yield. I believe right now, Eric Beyrich, we're probably 4.5 to 3.5, depending upon higher yield or lower yield on the two bookends.
Yeah, 3.6 to 4.5. Yep.
3.6 to 4.5, right? So when you talk about being diversified, each of those strategies, wherever you're in that risk spectrum, has more than 30 different holdings in it. And we intentionally chose that number because when you look at diversification, your goal is to reduce what's called specific risk to one specific security, or when Eric Beyrich and I, studied for our CFA, it was called unsystemic risk, right? And they've changed the name so many times, but it's single security risk. And statistically, you get very little extra diversification or reduction or elimination of that risk when you exceed 30. But we also want to have an opportunity to beat the S&P 500, have a good return. And the more stocks you have, the more you essentially become a shadow S&P 500 fund where you're mimicking the whole market. So we find that 30 plus is that sweet spot on the stock side, be able to get rid of that specific or unsystemic risk, but also be able to get you more, you have the potential to use Mr. Beyrich's, what I would say are superior stock picking skills, again, using a bottoms up strategy, selecting stocks to actually have a positive effect on the results of your portfolio. Because, please don't get me wrong, we're not anti-growth, but our message is income first and growth second. Now, if you're asking about diversification on the bonds and bond-like instrument side, we actually have even more holdings there. Because with all the different bond-like instrument categories, excuse me, we actually, we have to have, most of those portfolios are over 60 different holdings between bonds and preferreds and business development companies and REITs and so on. So I'm not sure, when you ask the question, I'm not sure, where it is or whatever, but that would be a good question if you get more specific to, again, talk to your advisor that introduced you to us, and then we can certainly go from there. Okay. Hey, we do whatever makes you happy within reason. That's our goal. And that's why I always point people back to the advisor that introduced you to our firm, because that's the person where he or she knows your situation, better than we do. We're good at the management side, but we need to rely on that person to really be the intermediary between you and us. Okay, next on the list, there's a question here about why. First of all, can you review the investments that were sold and purchased along the year and the reason for those transactions? The simple answer, unfortunately, Doug, is no. And it's not because we're trying to be difficult. It's because a lot of the portfolios are customized. And to some degree, depending upon when you became a client, you might have certain holdings or different holdings. So probably 80% of the trades that we made wouldn't have applied to your portfolio. So it's very likely we go through a huge laundry list of changes we've made throughout the year, and only a small portion of it applies to you. So that's something where if you have specific questions, communicate that to your advisor. Your advisor can get it to us, or you can come to us directly, even ask us, and we're accessible. Eric and Eric are both accessible to talk to anybody if they have specific questions on the portfolios, and then we can give you answers that are meaningful to you, not just generic answers across the the board company-wide. All right. Then there's a question about in some cases that when an investment is sold, it's not replaced immediately with an alternative. So I'm going to answer that two ways. First, I'm going to define the word immediately. Immediately, I would say, is within a 2-week period. So sometimes if it's not repurchased right away, it's because we're waiting for a certain price to trigger to get a better price on that purchase. But if it goes beyond 2 weeks, that's very rare. And if that happens, the reason most likely is because something unexpectedly got redeemed early, got called, and therefore we had to take time to look for what we thought was the most suitable replacement. And that does happen sometimes where companies will just refinance, they'll pay off their old debt and get something new. But if it's a intentional swap where we're getting out of something because we don't like it or because we like something else better, that's most often done within a 2-week period. So hopefully that helps. Okay, and John wants to know, so I think, John, that your advisor that introduced you to us may have let a little secret out of the bag because you're asking about, are we including any plans to trade options this year? We are looking into it, is the answer. Looking into it from a compliance standpoint, because there's additional hurdles with options trading that you really have to be careful of. But I will tell you that I actually talked to our chief compliance officer yesterday, who gave me some favorable information, which points us more toward the yes answer, that we should be able to do that in some ways later this year. But I want to be clear, there's 2 ways to really use options. One is speculation, and the other one is hedging or to generate income. We won't be using options to speculate. The options that we'll be using are more for hedging and or generating income. So I just want to make that clear also. And Eric, as I'm going through some of these answers, if you want to chime in with something you feel, just go ahead and interrupt me. Sure. But I think I haven't said anything that's embarrassed either one of you yet. Is that correct?
Correct. You're doing fine, Dave.
All right. Sounds good. Yeah. And by the way, you'll notice here how the 2 old farts with gray hair, we're not wearing sports coats because we feel like, yeah, okay, we're almost 60. We've kind of earned it. But our cohort, who's just a few years younger than us, but somehow doesn't have any gray hair yet. Is that really not gray, or do you touch that up? I need to know.
That's a secret, Dave.
You're in Southern Florida. It's I know people have more vanity here, so I wouldn't be surprised if you touched it up.
9 years here, I still have it, so that's a good sign.
Good sign. I love it. Okay, so next on the list, as I digress, how can I get transcripts from the webinar? So, Charles, our CCO, if you're still listening, you can put into the chat section whether or not it's okay, compliance-wise, for us to have a transcript. I'm not sure how to answer that question. Our CCO, I think, is in his office, whereas we're up here in the studio recording this. How is the loss of present tax rate, how is it going to affect investment strategies, Roth conversions, ETF costs, new tax potential, and et cetera, et cetera? I'm going to answer it, and then if either of you want to chime in, please do. But I would say this: it shouldn't have much. The biggest place it might have an effect is on Roth conversion strategies. In other words, as tax rates are set to reset back upwards slightly, it might make this year a good opportunity to do a Roth conversion better than previous years, depending upon better than subsequent years, depending upon your current situation. So that could be a great opportunity, or it could be something where if you've been doing a series of Roth conversions, the mathematics might say they don't make sense for you anymore, starting in the years coming when the tax law sunset. That would be really the biggest effect. As far as everything else, as far as the financial markets, I don't see it having a major effect one way or another with financial markets, because first of all, and again, correct me, Eric and Eric, if I'm out of school here, but capital gains, I believe, aren't an issue coming up on the sunset. Ordinary income taxes are, but again, each of those brackets would sunset back up just a little bit. And most investors aren't making decisions based upon a small incremental increase in tax rates. So I don't see it making a big difference in the financial markets. Any other comments, Eric and Eric, that you want to add to that?
Correct. It's kind of hard sometimes to comment on an individual's tax, situation. That's why we always, for my clients, we always bring in their CPAs and who's doing their taxes to go over things specifically with them. So I would encourage people to reach out to their advisors and their CPAs.
That's true. Very true. And I know a lot of your advisors actually have tax professionals that, whether they're in their office or with whom they have relationships, who can certainly help out there. Okay. Next on the list then, and you notice that Mr. Beyrich is being unusually quiet. This is unusual. It's kind of pleasant, actually, isn't it, Eric?
Eric, can you hear us?
It's not
Maybe
it's
not. Maybe the system's not working.
One in the group, even including me, but not right now.
You guys don't want me to talk about muni bonds and treasuries, so I'll just leave the fixed income to you.
Oh, we're talking about taxes right now, but the next question.
Sounds good.
Tax rates on will make municipal bonds and treasuries more appealing on a relative basis if they go up.
Yeah.
I agree with 100% with Dave on the Roths, but you don't need an echo, right? So I'm just gonna.
I know we're just teasing you there, Eric. All right. Is there a particular reason Sonicum Strategies hold stocks at a lower yield than the inflation rate? Well, even though that's an Eric Beyrich question, I think I can answer that favorably. The funny part is that if you go back 2.5 years, not only were the dividend yields on most of our common stocks higher than the inflation rate, but they're also higher than the yields on a lot of our bonds, right? But what's happened is with Jerome Powell, the increases in interest rates, the bond yields have come up, and of course that was all in response to inflation. So now, the yields are lower than on stocks are lower than bond yields. But I would argue that with the inflation rates having come down, the average yields in our portfolio, again, 3.6 to 4.5, are higher than today's current inflation rate. Now, when we were looking at 9% year over year, a year and a half ago, if Eric Beyrich tried to build a portfolio of common stocks with a 9% yield, you probably would have had a lot of stocks in the portfolio whose dividends have been since cut, or whose prices have diminished significantly. So we're trying to find that sweet spot for the highest dividend yield we can get and still give you some competitive growth potential. Did I say that right, Mr. Beyrich?
Dave, you're on a roll. Keep it up.
Okay, moving on. Let's do it. If a client does not need income, do you adjust your strategy for his portfolio? Yes, Greg, that would be a conversation that you would have with your advisor that introduced you to us, because your advisor, in determining how much is allocated in one sector or another, really depends upon your income needs now, your income needs in the future, and your risk tolerance level. So that would be a question for them. And once again, you know, we lean on that advisor, because that advisor knows you much better than we know you. Okay. Okay. Next on our list, the devaluation of the dollar, government going to possible digital dollars versus gold, and also thoughts on investments in crypto or gold. Well, we already addressed crypto, so who would like to address gold, and who would like to address concerns about the potential devaluation of the dollar?
I can talk about both if you'd like, but I don't know if Eric wants
Go
to.
ahead.
So
There you go.
one of the primary drivers of a devaluation of any currency is interest rates. And as interest rates fall, that should make the currency weaker on a relative basis, depending on how the others do. And that should help our exports, which would be very good for stocks. Also, the repatriated profits from overseas as the dollar falls would be higher nominally, which will help as well. In terms of gold, you know, when interest rates are high, generally speaking, gold doesn't do as well, because the opportunity cost of investing in gold is higher when you can earn more buying securities. When interest rates fall, the opportunity cost of being in gold is less. Now, balancing that, it's inflation. Gold tends to go up when people perceive inflation as a store of value, and it tends to go down when people feel that inflation is falling. So we have this cross current right now. Gold is being supported by the idea that rates are going to fall, but it's being hurt by the idea that inflation is going to fall. And that's why when people have asked me, I've been less sanguine about gold than some of the gold bugs have, but I'm not negative. I think gold will actually do well this year relative to, you know, say cash, probably, you know, in line, maybe a little bit better than cash, but probably in line. But you know, that's because of those cross currents. You know, basically.
So Eric, how about this factor that you know, the worldwide, in terms of central bank policy, it seems as though most established countries are more homogeneous now than they were in the past. So it seems like one person's tightening, all the central banks are tightening, they're loosening, they're all loosening. So if everyone's heading in the same direction, you know, is it even an issue anymore, the devaluation of our dollar?
It is, because we're moving faster than the others. It's a beguile thy neighbor strategy. It never works in the long run, but everybody chases their tail. And I actually think that the dollar will finish the year weaker, which will help our companies. In the first half, with this backup in rates, some of that benefit of the falling dollar is going to be lost, and that's going to be tougher for earnings in Q1 and Q2. But as you get into Q3 and Q4, I think that's a nice tailwind.
Eric Lutten, any comments on gold before we go to digital currency?
No, we left the gold standard behind, you know, without getting the conspiracy theories, which you accused me of. I think gold is a protected status among banks. They don't want to see gold go up to $3,000 or $4,000 per ounce. And I've seen a lot of money that would have gone to gold go into crypto, because I think a lot of people view Bitcoin as a form of stored value of gold. Now, whether you agree with that or not, people do see it that way.
Yeah, I've heard that many
But
times.
you know, I leave it at that.
One fly in the crypto ointment. The whole perception of scarcity of crypto is that it can only be manufactured at a certain pace. And as computer speeds pick up, you can make it faster and faster, which increases the probability of dilution. So,
Well, I think Bitcoin does have a limit, correct? And
well,
you can earn interest on storing your Bitcoin now. It's not a cost. There are companies that will pay you.
well, I hope that they continue to pay you, because there's a tremendous energy cost to sustain it. but I'm just,
Yeah.
For mining, sure. So how about, just forget about Bitcoin per se, how about, governmental digital assets, being based on, pegged to something like that? That was the part two of the question.
Yeah.
well, you
Are they
add,
going to move to crypto?
you added the peg to it. I don't think the peg was in there, but
I did, you're right.
so basically we have digital currency now. I mean, the question is are you talking about it's going to be some form of crypto? And the answer is maybe, but if it's pegged as you described, you're not going to have the same speculative appeal that you have for some of these, we'll call it private enterprises. But there's all the, like Eric was mentioning, conspiracy theories. One of the more radical conspiracy theories is that the government's going to go to digital currency and then basically rebase it and wipe everybody out and things like that. I don't believe that, but people can speculate. I'm not worried about having more digital currency because everything is digital now, essentially anyway. We don't really know what the current balances are, except for what we're told. That's what fiat money is all about.
Good. Any comments on digital currency from your standpoint, is how it relates to the Federal Reserve?
Will they move to a central bank digital currency? That is the talk. The Fed's been talking with different cryptocurrencies and meetings. Whether that comes to fruition or not, we'll see.
Okay.
All I know is I don't think they're going to let up on spending.
Yeah. And the reality is it shouldn't, if that does come to fruition, it's not going to really, it doesn't affect much, because you think about all the transactions we've done lately. I mean, most of our transactions are digital. I mean, people don't walk around with cash in their pockets much anymore. Everything's been done digitally for a while. It's just that now we attach the name digital currency to it, just like artificial intelligence, right? We've had artificial intelligence for 40, 50 years, but it's just now that it's tagged that name, and it's improving at such a exponentially more and more rapid pace that now it's finally caught the news headline. So that's kind of how I look at that, from the digital currency standpoint.
Next question.
Okay, let's see here. Okay, so we have one of our advisors here. Clients sometimes are giddy chasing the high returns of 26% in the S&P 500 for 2023. How are you articulating the need to take the chips off the table, get back to income investing instead of chasing the magnificent 7? Well, that's a great question, and I know, Brian, why you're asking it because a lot of our listeners, maybe some of your clients here, are thinking the same thing because of FOMO, right? I just got done saying I don't believe in cryptocurrency, be it I have a little bit because of FOMO. So it's no surprise that our clients have a little bit of natural FOMO when they hear the market's going up 26%. I think what you have to realize is that it is first of all, it's timing. Everything's cyclical. Mr. Beyrich showed the chart of when growth, like these stocks, versus value, when they tend to, one does better than the other. And so that's one thing I think that's important for your clients to understand, for everybody listening to understand. And also, I think it's important that when you take out the fact that these 7 stocks have done well and have an equally weighted S&P 500, it's not up 26, it's up 12 last year. And then when you take those 7 stocks out and leave the other 493 or so in there, it wasn't even up 10%. So again, those really did go up and drive the markets through last year. And what I tell people, and Eric Lutten, so here it is, Mr. Lutten, the bond guy, who actually came up with this before and said, look, if you want that type of thing, you want some of that, you need to think of it as a floater on a cocktail. You're down an island somewhere, you're having a rum drink, and you put a floater on it, right? It's not the drink, it's just a floater on the drink. So for people who are retired or within 10 years of retirement, if you want to have a little bit of money in stocks like that are growthier, that's okay, but you just have to think of it as the floater. You can't think of it as the drink.
The rum runner.
That's right. That's right. It's the thing that says, hey, I've got my I need goals covered in retirement with bonds and bond-like instruments and high dividend, high quality common stocks. And then I, don't have enough money to get all my I want goals. So maybe I'll just be a little bit more aggressive. So maybe some of the things we really want in retirement versus what we need could be accomplished if these growthier names continue to run. So that's my take on it there. Mr. Beyrich, any added comments?
No, I think that's absolutely right. I think one of the things, we talk about stocks versus bonds a lot. It's really not a war of stocks versus bonds, and it's not even a war against value versus growth. They have different characteristics, and all of them have merits and vices to them. And what our goal is besides making you happy all the time, is to inform you about the differences, so you feel informed, so that you know what you're doing and why you're doing it. And you don't feel constrained like you have to do one thing because that's what I was told, so that you understand. So I think that makes perfect sense.
Okay, excellent. I love it. Okay, so since we're talking about that, you want to talk briefly about the Magnificent Seven and who they are, since at least a couple of them have actually changed their names since we put FANG together initially. So the corporate identity gets confused. So
in there, and you're good.
what's that?
Add NVIDIA, and then you've got the added one that matters the most. That's pretty much.
NVIDIA and Microsoft.
Yep, correct.
Yeah,
And
NVIDIA
Netflix is
Microsoft.
out.
That's correct. And
Well,
Facebook, or whatever they're calling themselves now, and
Meta.
yeah, and Apple and Amazon, yep, and Google, whatever they're calling themselves now, right? and all that. So good, and it makes sense because of those stocks are running. Even Microsoft, a big established company, been around longer than most others. I remember when Bill Gates was the richest man in the world because of Microsoft. I'm dating myself, but and back in with incredible growth so far the last couple of years. So it's all good stuff. Let's see. I heard once a person pays high commissions, 8% and 16% respectively, to buy and sell gold. I really don't have a clue to this one. Anybody, either you know about commissions?
Find a new commodities broker if that's what you're paying in spread.
What should the commissions be to buy and sell gold? What would you say?
Well,
Nowhere near that.
it depends on what you're doing. And also your storage costs are a bigger issue typically than your commissions. If you're buying gold, I think Eric's comment is right, from somebody in New Hampshire that's going to warehouse it. If that's what you want, instead of buying the GLDs, you should pay below 5% in either direction. But it's the storage cost for physical specie that kill you. That's why most people buy, Krugerrands and bars and keep them in the safe of their house behind a wall of ammunition, right? It's cheaper to do it that way. I used to buy GLDs when I thought gold was, just because it was liquid and could get in and out. But it's sort of insane if you think about it. You're going to buy blocks of gold that you never see and touch, and you're going to pay somebody, 3-4% a year to store it. So you're eroding your value. And if you need it in the case of, the nuclear strike strategy, you can't get it because it's in some box in New Hampshire or Colorado or wherever it is. So, but anyway, yeah, those are high numbers loaded. They don't make sense to me. And you can do it a lot cheaper. If you just want exposure, buy the GLDs, they're really cheap.
Yeah. If you're paying those types of rates that were quoted here on this chat question bar, thank you, then that's
Pretty steep.
probably one of the companies you saw on TV. There's a lot of television, they sit there, and that's what we call them, the gold bugs, because no matter what's happening, gold is the answer. And the reality is that if you're paying that much, it's possible that that's who that person is working through that said the commissions are as much as 8 or 16. They certainly should be much less than that. And while we're on this, we have a question here that says, is gold and silver investment vehicle you'd recommend in a personal portfolio? Simple answer is, again, it's some degree, it's kind of like, if I said, the Magnificent Seven should be a floater. It should be maybe 10% of your portfolio. If you're retired or close to retirement, certainly not much more. And those are companies that are actually earning profits, that are generating money, right? Then I would say the same is true to a greater extent with gold and silver. So you certainly would want to keep those even in smaller percentages. But again, it comes down to, if you have enough income getting generated from your portfolio to live the retirement you want, and you have extra capital, you don't need to generate income, then that's capital that you would use for those Magnificent Seven. or for commodities, or even if you want to roll the dice on crypto, that's capital you use for that. Okay. If there's a significant amount of bonds coming due in the next year or two, is there risk to reinvestment, and what can I expect an attempt to offset that risk? Mr. Lutten?
Yeah. We'd have to look at your individual portfolio, but as the firm, we don't have too many that are coming due in the next 12 to 18 months as a holdings. If you do, I would look, and like I said in my presentation, we would definitely look to extend that duration, sell those bonds, and go into longer duration credits that we like going forward. So that's a simple fix. If your particular portfolio has, and some people have some legacy bonds for newer clients that have transferred in, they might have really short duration assets maturing in a year or two. Those will definitely be under review by your advisor and also by us. So that's, like I said, that's an easy fix, and we are looking to extend duration in our bond portfolio. So.
And that'll remember, there's three levers, in the bond world. There's the interest rate environment, short-term and long-term. There's the shape of the yield curve, and then there's the credit spreads. Whether you single A, double, triple B, double B, and all that. So we have levers to help offset that reinvestment risk. But also, I will say that we don't have a lot of bonds that actually mature. We get some that get called because of the rolling down the risk curve, the yield curve comment, where typically when something gets within 2 years or so, the yields start to come down, where it means the prices firm up, which means we can actually sell those at a reasonable dollar amount and actually put that money into something that's a little long-term and higher yield.
We'll roll them. It's called rolling down the yield curve.
Yeah. So it's not often we actually get to maturity. So I hope that helps with the answer about the bonds that are coming due in the next couple of years. How often should you rebalance and reinvest after speaking to your advisor? Well, let me say this. Rebalancing is somewhat overrated. There are a lot of, even if you excuse the term, not even robo-advisors, but some advisors that you think are customizing portfolios for you that are using robo-technologies behind the scenes that are constantly reinvesting and constantly rebalancing, maybe every quarter. And a lot of that is, I believe, salesmanship. It's because they roll up their sleeves and they want to give the impression they're actually working for you. Look at all these reallocations we're making, when really it's all computer driven. The reality is the most important time to rebalance your portfolio is when your goals change. If your goals change, you think you'd retire in 10 years and now you decide, I don't want to make it 10 more years, I want to retire earlier, or vice versa, or you get laid off and you get forced into retirement, like happened to a lot of people during the pandemic, right? That's the biggest driver as to when you reallocate. The second biggest driver is when things start to get significantly lopsided. It's not as though if I have 30% in stocks and 70% in bonds and bonds like instruments, the stocks do better and now I'm up to 33%. Ooh, I need to reallocate. No, but if it goes from 30 up to 40, 45, well, then you might want to reallocate. So the answer is reallocations are a lot less frequent than a lot of advisors would lead you to believe. Okay. Anything to add, gentlemen, or should we move on to the next question?
Moving on.
Okay. All righty. Let's see here. We have a lot of questions. I have to speed this up. We have to be done in about 30 minutes. So here we go. Income focused strategy, should some more of my holdings be converted from traditional to Roth? I kind of answered that before in terms of the opportunities with Roth. So what I would say is that's a great question. I would send you back to your advisor that introduced you to us for that, because as Eric Lutten said, that's something that's a customized question regarding your tax brackets, where you are. All right. Why do I see shares of such low quality in my account when there's money available in the account for larger shares to be purchased? Okay.
I think they mean quantity.
Yeah. So the answer most commonly is because, we like something at a certain price. We don't like it at a higher price if we're buying it. If we're selling it, we like to sell it at this price. If the price goes down, we don't want to sell it at this price necessarily. So sometimes, you know, we say we want to sell this and we want to buy this that's a little cheaper. But as we start doing that, you know, the price of the thing we're selling, you know, comes down a bit and the price of the thing we're buying comes up, and then we stop. So what looked like a good opportunity ended up not being a good opportunity in the long run. So we may have had intent to buy a higher quantity of something, and we just didn't. And I would say that's probably the most common reason you see that. And I think Eric Lutten, that's probably more in your side of the equation.
No, actually, it'll fall more on the equity side. And the reason being is because as they're purchasing, they don't necessarily get all the shares they want that trading session. So they have to legally, we have to what's called prorate. We want to treat all clients in that strategy equal.
Right.
So there might only be 10 shares. And then maybe a day or two later, you'll get another 10 or 20 shares to complete the order. But sometimes that does happen. But they do try to buy as much as they can at the prices we like. But
well, the other thing is on Mr. Beyrich's side, on the equity side, the reality is, you know, sometimes, Eric Beyrich, I've seen you say, I think I like this. I want to stick my toe in the water with some of it. And we get a little pullback, I'll buy more. So sometimes that's part of it too.
Yeah, I think part of the question, and I get asked this question a lot, is that some of the accounts have more cash than they want. And I think that's a conversation with the advisors, because I don't, the cash generated from the dividends, it's the assumption is that it goes into the account for the people to take out and do what they want to do with. It doesn't automatically flow back in, and that's a different conversation. That's not our strategy. I mean, my strategy is to, when I sell something, buy something right away. I'm not waiting for a better price. If I made the decision before I put in the order, it's a little different in bonds where things are not as available. So I think the question is also, why am I pulling so much cash in my fund? And that's a different, that's not what I deal with. That's more what you and your advisor deal with.
Fair enough. All right, moving on. So how do we know if our advisor has followed your buy-sell model? Well, that's easy. We're actually making the trades here. So your advisor is really determining, you know, the allocation, because your advisor knows you better than we do, like I said before. And then once we get the allocation, we're making the trades, we're doing the day-to-day management. And then when you meet with your advisor and your advisor has seen that something has changed in your life that would warrant a change in allocation, then your advisor, he or she, lets us know that. So yes, they are always following our buy-sell models by definition. So good. That was an easy one. Get that answered quick. Okay. Questions here about our exchange-traded funds. I'm not going to answer that because I got yelled at in the chat by our CCO for even mentioning the two ETFs. So sadly, I'm not going to answer that question because I'm already in hot water for that one. You expect that government bonds interest rates will end their inverted status in 2024? And Mr. Lutten, I think you had said the answer is yes.
yeah, well, we expect it to, but here's the problem. If inflation does stay a little sticky, the Fed's going to take their sweet time about lowering rates. And if they do that, we'll still be in somewhat of an inverted status. If they go a full percent, let's say in the summer, second half of the year, we'll be back to a flat curve. Mm-hmm. And then just one more move, even if it's a quarter or a 50 basis point move, then we should be slightly positive. But we're not going to see the positive slope curve we saw 3 or 4 years ago. We probably won't see that until late 2025.
Yeah, well, bare minimum, we're going to be inverted less toward the end of 2024, if not right sized. You think the presidential election will have any effect on the economy? You know, it's funny. I'm gonna because you're clients, I'm gonna show you a little sneak peek under the hood here. No, I don't go in on weekends and do my radio show. Okay, so if any of you have my radio show in your area, it's recorded. Now, don't tell anybody that. It's a big secret. And we just recorded it actually this morning, and it was all about the presidential election and how it's going to have really little effect on your retirement investment planning. The simple answer is no. And if you're not in an area where you can get the show live, It should be attached to our retirement income source website shortly after the weekend. And you can get on our retirement income source radio show website and listen to the show and see the argument that I made in that direction.
But Dave, that was a different question. The question wasn't how does it affect your long-term retirement income? How will it affect the economy, or might it affect the economy? And the answer
Well,
is that.
I translated it because I think most people are here because they're really concerned about the investments and how it affects the portfolios. So I took a little liberty there to answer it. And that's a good point. Economy and financial markets aren't necessarily the same. They don't go in lockstep. But you're right, it could affect the economy. And it's really simple. Pro-business administration generally is a little better for the economy. Administration that puts roadblocks up to pro-business philosophies tends to be a little bit worse for the economy. That's probably the one of the biggest things I would throw out there. But in terms of financial markets, I remember the old saying that Republican administrations are great for the stock market, Democratic administrations are not. That got blown out of the window so much. It got blown out of the window during the Clinton administration when the markets did really well. George W. Bush, when the markets did terribly. Obama administration, the markets did well. So, I don't put too much credence in that. That's a great question because I've heard so many people say, I don't want to make any changes after the election. I mean, every election cycle, I hear clients say this. And I think I was going to use the word nonsensical, but I don't want to be condescending about it. But the reality is, you need to make decisions on your money based upon your goals and what's important to you, not on, who's sitting in the White House. Especially this year, because I think without being political, I think I can say that we probably have a majority of people watching and listening today who aren't necessarily excited about any of our candidates so far on this election cycle. So let's leave it at that. Okay, we mentioned gold, silver. We covered that. Oh, transcript. So our CCO, our illustrious CCO, Mr. Charles Radlauer, says you can provide a transcript if you provide it with proper disclosures attached. So whoever asked the question about the transcript, I'd encourage you to go to your advisor, that introduce you to us, let that advisor know you want that, and then your office can come to us and we'll make sure we make that happen. Okay. All right, moving on. Gold, silver. Oh, what a shocker. We have questions about Charles Schwab in that incredibly smooth integration that all of you were part of, from TD Ameritrade to Schwab. Even though we had nothing to do with that, and we're trying hard to make that better and are just fighting an uphill battle, I still want to sincerely apologize to you who are watching this, listening to this, because it had been a complete debacle. The technology at Schwab is not nearly as good as the technology at TD Ameritrade. A lot of you have seen your yield, your income go down on paper, even though it hasn't gone down, but there's certain holdings that they can't, just from technology standpoint. I literally got on the phone myself with top people at Schwab, threatened that we would move billions of dollars away from them. And they actually said, this could take a year for us to fix this technology where those securities that don't have a dividend yield that's stated on the statements, which makes it look like your income went down even though it didn't, that it might take as much as a year to fix that. And they're not even sure they want to take the time to fix it, which unfortunately is a testament to the fact that most advisors are total return based. Most advisors don't do what we do with an income first, growth second philosophy. They don't care if the income column is accurate on the statement or not. And that's just unfortunate. So again, I apologize, even though we're doing everything we can to make it better and have zero control over Schwab corporate. I apologize for the headache that you've gone through when it comes to this. And also apologize to the advisor that led you to us, because a lot of your advisors are through Schwab, and even some of the other simple tasks like taking withdrawals, getting checks sent to you, all those tasks were much easier, much quicker with TD Ameritrade than they are with Schwab. A big headache. So we're doing everything we can to make that better. And I would say, no, they haven't fixed their administrative issues. And I hope and pray that they are going to convert the functionality to be a little bit closer to what you had with TD Ameritrade, but I'm not sure. But all I can tell you is that if that's really a concern to you, those things, then, we can't, it would be a nightmare for your advisor to do this for all of his or her clients. But, we also clear through Fidelity. So Fidelity is an option. If you really are concerned about it, give your advisor a call and talk about the possibility of repapering and going to another clearinghouse like Fidelity. Right? So we do have options is the answer if it's really a concern to you. Okay. Stocks from companies that have a high ESG rating, are they detrimental to one's portfolio? Well, the answer is not necessarily, but possibly. Mr. Beyrich, you want to take that?
Sure. There's a little bit of correlation and causation. Generally speaking, anything a company does that isn't going to help its fundamental business, whether it's ESG, woke, or whatever you want to call it, is a negative. And one of the reasons why European companies in general have lower returns than North American companies is because they have a higher quotient of what might be called ESG behaviors. So we tend to look for companies that have less of them, not because of them, but just as companies that are doing things to improve their economics. Now, in some industries, like the media industry, it's very hard to avoid that because they're very touchy, or in the advertising, Omnicom and IPG, and they have what would be high ESG scores, but they're excellent businesses. So it doesn't deter us in any way. Margin is a negative feature, but it's not usually a big enough feature to push us over the edge.
And the real negative feature is if you're limiting yourself to certain companies based upon that, then, you take a filter. Eric Beyrich talked about how he filters, 12,000 companies down to really just a couple hundred that are even possibles, and then filters it down to the 30 plus in your portfolio. So now if ESG is a filter, that 12,000 number becomes much, much, much lower to start with, and you eliminate a good opportunities. So, and by the way, we have Kathleen who responded, I'm excited about Biden. Well, all I can say is just then I hope and pray that he stays healthy another 4 years. One of the concerns about obviously both the leading candidates right now is just, hey, can they stay healthy and sharp and stay in the saddle, whoever you're favoring? Because I made a joke about myself and Mr. Beyrich getting up there in years, but we're no comparison to Mr. Trump and Mr. Biden in terms of age. Okay, but then again, I'm going to a funeral this weekend of a good friend of mine's mom who was very sharp right up until the day she died in her sleep earlier this week at age 96. So you never know. Next, okay. Are you screening out for companies with woke practices? So that's the opposite of the ESG question. So the answer is really the same. It's although there is a slight drag on performance due to ESG or what you might call wokeness, the reality of it is that we try to make it a non-factor. We try to look at the company based upon its own merits, its own upside potential. And Mr. Beyrich said, catalyst, having the appropriate catalyst. So we don't look for certain ones. We don't screen out others. I was a fan of your television show before you left the station. Is there a place where I can view your full shows other than segments on YouTube? Really now it's just YouTube. But we have our radio show, and our radio show couples with a video and a podcast, myself and Sarah. I now have a sidekick. So if you want to watch that, go to the Retirement Income Source radio show. Does that sound right there? Yeah, Mondo's nodding. Great. Retirement Income Source radio show, and you get to see all current things. It's just like a television show because we're in studio, even though most people are listening to just the auditory version. Okay, we just do the video too because some people have podcasts that they like to watch the video, so that's why. Does sound income strategies do background checks on advisors before they're allowed to use SIS services? Well, you better believe we do. We do background checks before we even hire an internal employee, and especially for advisors. And I will tell you, there's a lot of advisors that have had issues that came to us that can move over a good quantity of clients' money that we have just refused because what we don't want to do is take the risk of tarnishing our reputation in any way. Now, that's not to say that there isn't an advisor here or there who has a black mark on his or her record that we don't take on. But, you know, we need to get all the evidence and look at it before we decide that we're comfortable with that person acting as a fiduciary representing us on behalf of you. Okay, so yes, we look at it. We probably put it through a stricter filter than most other firms, quite frankly. Let's see here. Okay, all right. I don't know if. I think that's it. I think we got our questions answered. I think we're good. And let's see here. It's did I miss anything? Let's see.
How many clients do you fill?
Where's that? How many?
We got, how many clients do you fill an advisor can effectively manage? Well, I guess that depends on the advisor and their capacity.
Depends on the firm.
Yeah.
You know, my Connecticut office, in my practice, we have 22 or 23 people, and we have 9 advisors who are fiduciaries. So we can service a lot of people. Now, if it's just an advisor with an assistant, that's a little bit of a different story. But one of the things that we do as a firm is we coach advisors on, as they grow and as their clientele grows, how to reinvest back in the business and bring other people on who can increase that level of service. So it really becomes infinite as long as you're running your business like a business. I missed that. Sorry. All right, I think we have it all. Bear with me. I'm just doing a double check here on everything.
Yeah, we're good.
All right. So yeah, so that's it, everybody. I got a little update as far as this year. We know where we were last year. We know where we are now, and I think they have a consensus. I will tell you personally, I get a little bit nervous because whenever you have a lot of people on one side of an issue, and right now there's a lot of people, you know, nobody's really expecting a very bad year in the financial markets in 2024. So I will admit, and I'm sure Eric and Eric have a little bit of this feeling in their innards too, that when most analysts and portfolio managers are on the side of the trade that say, hey, the markets should be okay this year, nobody's predicting a bad market, the superstitious part of all of us starts to worry a little bit.
Yeah. Every time I hear soft landing, I get nervous.
That's right. Every time you hear soft landing, you get nervous. You always think about what is that black swan event that can come and bite us in the proverbial rear.
Absolutely.
So we'll be keeping an eye out for that black swan event, and you can rest assured if we see anything coming up that we will make adjustments in the portfolio. Much like when we first had the pandemic, we sat down, Eric Lutten and I sat down, you know, almost immediately and poured through the portfolios and started looking at balance sheets and how long these companies could actually pay full payroll if they couldn't sell any products or services and the revenue went to zero. So we'll be keeping a look out for any black swan events, but barring a black swan event, it looks like, you know, 2024, with any luck, will be a pretty smooth year. So if you have any questions, you can reach out to us or even preferably your financial advisor, because again, he or she knows your situation better than we do. But hopefully this answered your questions today and you got a lot out of it. And hopefully it reaffirmed your understanding about why being retired or within 10 years of retirement, having an income first and growth second philosophy is so incredibly important. And also to have faith in your team, not just your advisor that you get to meet with on a regular basis, but also in us behind the scenes, as you're kind enough to put up with me as I bragged about just a little bit with the Morningstar ratings and Mr. Lutten having a fund that's #1 out of 150 in its class. So again, everybody, thanks so much. Hope you enjoy or make it through the rest of the winter here for those of you in northernmost climates, and we'll be back with you in 6 months. Thank you.
Thank you.